Hi, everyone. In the wake of the devastating news of the closing of Silicon Valley Bank, the second largest bank failure in U.S. history, the banking world is in chaos and the ripple effect is being felt far and wide. All the major U.S. indexes closed at least 1% lower on Friday, and European banking stocks have been down 5.5% since the news broke. The U.S. Federal Reserve said all deposits will be made whole, but the roots of the crisis lie deeper. /n/n So what happened? SVB had been a reliable source of funding for tech startups and venture capital firms for 40 years, a subsidiary of the SVB Financial Group based in California. When the Federal Board of Reserve changed from fractional reserves to no reserves, SVB and other banks began buying assets instead of simply loaning money. It was the tipping point for the bank, when it had to sell $21 billion of its securities at a $1.8 billion loss, and announced it needed to raise $2.25 billion to meet customers' withdrawal needs and fund new lending. /n/n Many analysts are now asking what the regulators were doing throughout all this. SVB was taking significantly more risk than many other banks, with a high level of loans and securities as a percentage of deposits, while relying heavily on corporate deposits rather than retail customers. Prices of the company's financial holdings dropped drastically in response to the Fed's aggressive rate hikes, and in the course of one panic day, SVB's stock tanked 60%, leading to an $80 billion haircut in value across the U.S. banking industry. /n/n The fallout of this crisis is still being felt, with legendary investor Michael Burry calling out the hubris and greed that could have fueled these stupid risks. The U.S. Treasury Department, Federal Reserve, and Federal Deposit Insurance Corporation have all announced plans to guarantee depositors' funds and curb contagion risk, but Fitzgerald from the Fitzgerald Group has said that the system needs to be seriously reviewed. He believes the regulators were complicit and put us in this mess in the first place, and now questions about the rating system and auditors will be asked. /n/n So what can we learn from this? Well, first off, banking should actually be boring. And anytime it's not, fundamental issues may be at the root of it. Greed and avarice have consequences, let this be a reminder. And regulators must act and intervene to prevent such a crisis from happening in the future. /n/n Thanks for watching.